We are on time, 6 p.m. Let's get started.
Sure.
Great. Okay. Good evening, everyone. Welcome to our new series hosted by Masters India. Giving you a brief about Masters India, we are a GST Suvidha provider appointed by the Goods and Service Tax Network. We have started this new series to help taxpayers understand the concept of GST, and that's why we call it Ask Masters. Luckily for us, our opening batsman today is Mr. Siddharth Nigam. He's a director at On Point Advisors and an ICIA member and a law graduate. I would want to ask him to introduce himself so we could know more about him from you.
Yeah, I'll do that. Hi, everyone. My name is Siddharth Nigam. I'm a chartered accountant and a lawyer by profession, and I am into consulting for last helping clients in GST transition, service tax, VAT, excise matters, GST matters, customs matters, representation, consulting, and all. So indirect tax is obviously my core area of expertise. Before that, for 4 years, I have worked in industry with a big construction company in India. And I feel obliged to be connected with Masters India for this session and look forward to learning from you all.
Thank you, Siddharth. It's a pleasure to have you with us. So, coming to the topic for today. So, as we all are aware, 31st October is the D Day to file GSTR 9 and 9C. That's the reason we thought why not cover those points which you need to check when you're at the due date or nearing the due date. That's why we bring to you this session as a checklist session for the last minute checks. So that can you tell us something more about what is this GSTR 9 and why is GSTR 9C different from GSTR 9?
Yeah, so I'd say that this GSTR 9 and 9C typically is a concept which has been borrowed from earlier VAT laws. 9 is typically a return, it's called annual return, where a taxpayer himself assess his tax liability and report it to the government on a consolidated basis, on a financial year basis. Because in Indian GST, the compliances you have like GSTR 1, GSTR 3B, these are like monthly compliances. And for few people, these are like quarterly compliances, right? But whenever government authorities are intending to assess you for a particular financial year, they would obviously want to look at the numbers consolidated for a financial year basis so that you are able to reconcile or maybe support them with your audited financial statements number. And that is the whole reason it works on a financial year basis only, right? To get the double verification in terms of numbers which are reported and particularly the complexity, since GST is a state-based subject, right? So there can be entities who have maybe 10, 15, 20, 25 registrations in India. And since GST compliances, whatever they have to be done on a state level basis. It's a very big task for such entities to bifurcate their consolidated all India, pan India level books of accounts into multiple state trial balances and then go for reconciliation of outward inward supplies along with the GST returns, right? And that is something, if done at a assessment stage, would pose problems particularly for big taxpayers because assessments normally happens 3 4 years down the line. By that time there may be very small petty gaps or maybe big gaps for which it would be difficult to trace the documents or look for the information for past periods, right? And that's where I think the intention of government is and the intention of audit is that as soon as you complete a year, you have 6 months or 9 months time, you file your annual return based on whatever correct reporting you have for a particular financial year. Then you prepare a reconciliation statement in form 9C, get it certified by an external chartered accountant, and then your compliances for a particular financial year is closed.
We're speaking about GSTR 9 being a consolidated return. So,
Right.
what in case there is an extra turnover or there is an extra liability which needs to be recorded? Is it possible in the GSTR 9?
Yes, initially the sentiment was that whatever you have reported as part of your monthly GST 3B filings, that consolidated number has to be reported as the turnover or maybe inward outward turnover of in GSTR 9 annual return, right? But later on, it was clarified by way of instructions in GSTR 9 form only. There were additional instructions which were added to clarify the doubt, and which stated that yes, if there is a portion of your liability or maybe portion of your ITC which has been missed, which you need to adjust. Because see, GSTR 3B filings, you file a return, there is no option to revise. There is only one way: you adjust whatever is missed out, you adjust in subsequent return or maybe return for the tax period when you have identified whatever gap has happened during that time, right? So yes, there was an instruction. Instruction was very clear. They said that if there is anything related to the liability, additional liability, yes, you can report it in your annual return. But if there is something which is related to your additional claim of input tax credit, that is something which you cannot take through GSTR 9. There is a reason for that. The reason is that there is a input tax credit ledger on our portal. We typically call it electronic credit ledger, right? So if I want my ITC to hit my electronic credit ledger so that tomorrow at a later stage I'm able to use that tax credit for paying my output tax liabilities, that has to be routed only through GSTR 3B returns. Even if you claim anything additional in GSTR 9 annual return, if it won't hit your credit ledger, it won't make any sense. And that is something where government has clarified, and till date, this is the position that if there is any additional liability or correction in liability which you want to report or you missed reporting in a particular financial year, then answer is yes, that can be done in GSTR 9. If it is something related to ITC, you need to go back and check the time limits within the law. If it is within time limit, you are eligible to claim. You do not claim it in the annual return, you claim it in your 3B return.
Okay. So here I have one thing to take back, that we cannot revise our GSTR 9. Am I right?
Yes, yes. Once filed, it is something which cannot be revised.
Cannot be revised. And another thing about the ITC bit of it, what you said. So basically, when the GSTR 9 is getting filed, there may be instances where there may be a tax amount payable. So how is this payment supposed to be done? So is it supposed to be done through a bank payment, or can the unutilized ITC be used for it? How is it supposed to be done?
Yes, this is again one point because see, initial years we have seen that many taxpayers have in initial days faced with many problems, right? So when you sit for a particular financial year and you reconcile what you have reported on monthly basis versus books of accounts, in many situations you come across a liability or maybe you come across a transaction where there is something additional which was supposed to be paid, and those transactions in first instances are identified only at the time of these annual filings, only at the time of these reconciliations, right? Now there is an instruction again in these forms, and the instruction is obviously issued by the government, which says that in case there is any additional liability which is coming out of your annual return or GST audit exercise, then that liability can be paid using cash ledger only. That means you have to pay through bank payment only, and you cannot utilize your input tax credit for that liability, right? But if I look at the law, I do not find any such restriction that law prohibits or maybe certain section, rule, provision, notification, any such thing which has a force of law. Nothing of that sort prohibits using your input tax credit for paying off your liabilities which you may have identified during the annual return process, right? And there is an added factor to it. Like what happens typically is whenever in GST we identify a liability at a later stage, there is a good option, there is a best practice scenario that there is a form called DRC 03, which is basically the voluntary payment
Payment
of
form.
tax which taxpayers use to discharge any missed liability, right? So if we go to DRC section on the portal and then we choose the option annual return, there is a separate DRC for annual returns as well. So if we choose the option of DRC for annual return, It allows me to declare my tax. It allows me to discharge that additional tax using cash ledger payment or ITC ledger payment, right? So my point is, when the portal itself is not blocking ITC, law
Why stop?
does not have a restriction, right? Then why can a restriction be imposed using the instruction, right? But there are certain facts which taxpayers needs to be mindful of. There all liabilities which you may identify during the annual return process, all those liabilities are not eligible for set off from your input tax credit. If there is a liability which is coming out of your outward supplies, maybe your forward charge liability, you can use your input tax credit to discharge that using the annual return DRC 03 route, which we just discussed. But if there is a liability which is in respect of reverse charge payments, where there is a mandate that you cannot pay this liability using your input tax credit, right? Those liabilities again have to be discharged through cash ledger only. If there are certain liabilities, maybe interest, late fees, or any such liabilities which are again required or mandated to be paid only through cash ledgers, those liabilities again are to be deposited using cash ledger only. So there is very limited sense in which input tax credit can be used for discharging annual filings liability, but my answer would be yes, it can be done.
Okay, great. I'm glad we are having a practical scenario here as well, that the law permits it, but then there is an instruction given that you cannot use it. That's how I'm summarizing it.
Yes.
Yes. So in case someone utilizes it for the eligible sectors, okay, not where it is specifically supposed to be paid to the cash ledger, is there a scope for notice or is there a scope for rejection? What do you have to say in that regard?
So there is a scope of notice for everything, right? So you cannot limit the scope of notice for anything, because notice is basically something which seeks information, or which seeks your view, right?
Correct.
So there is a scope of notice for everything, whether it is right or wrong, I would say. But yes, there can be a person, there can be a tax officer, there can be a tax commissioner who may have a contrary view. Not that this point has been discussed till now in any of the departmental interactions in my personal experience, but yes, obviously there can be a notice and there can be a situation where everybody is as clear as I am.
Okay, great. I think we need to make this message very loud that getting a notice is just to show what your view is or to express what your view or understanding about the situation is. It's nothing to panic at the initial step.
Yes, yes. Notice is something which I would just say it's a exchange of letter, right? There is some information which tax officers are requesting for you from you, right? If you are right, you provide the information. It's closed. Nothing more
I
is
think
to
that's
be
the
done.
reason it's called, some of them are called show cause notice, show the cause for it.
Exactly.
Yeah. Okay, great. So there is one more question which I keep hearing during my experience as well, that the auto-populated data of 2A and the table 8A of GSTR 9. There are times where these data don't match. Why doesn't it match, and what could be done in that situation?
Yes, this particular question has been haunting us even for some time in past, but then there was a clarity, I would say, right? So initially when these forms were introduced, like financial year 17-18 was the first year of GST annual return audit compliance, right? So when these forms were initially introduced, there were no base, there was no hint that from where these numbers are coming from. But later on, it was clarified that whatever number is being auto-populated, I think it's 8A, 8B, somewhere in table 8, right? These auto-populated 2A numbers are there. These are auto-populated. And if you want to get a 2A status of those numbers, these are based on 1st November of the subsequent financial year 2A status. See, 2A GSTR 2A is a very dynamic report. As soon as my vendor declares something or maybe add or amends the invoice, my entire 2A total changes. Then I need to go figure out, use my softwares, use my hardware to figure out what has exactly changed over the last night, right? So 2A is typically a dynamic report, and if you want to arrive at the number which is auto populated by the portal, then it is the 1st November to a status of subsequent financial year. Like if we are talking about 17-18 annual return, it would be 1st November 2018 to a status which was being auto populated. Similarly for 18-19, it was like 1st November 2019. And in fact, we are just about to come to 1st November 2020, and we are yet to file financial year 1920 annual return. So what I can suggest to taxpayers is, yes, 1st November is about to come. You download your GSTR 2A and double verify this point, that as soon as your portal opens up for annual filing requirement, whether that number reconciles with what is being auto populated over there. Right. In addition to that, there was another facility, I would say, which was given by the government last year onwards. Like there is an auto-populated number. For first year, there was no base, but after that, there was an option which was added on the portal, which allows you to download the invoice level or transaction level breakup of the auto-populated number. Right. That is something which can be useful for all the taxpayers so far as reconciliation with that auto-populated amount is concerned.
Okay. So when you were mentioning about the vendor thing, there was another thing that struck me. So the GST returns is something the government has enabled, that when the vendor files, it reflects in the supplier's books or in
Right.
supplier's documents, right? So how do we fix the situation or treat the situation when there is a difference with the ITC which is auto-populated through the vendor reporting and the ITC which is actually availed? There can be chances that there will be difference, and how do we fix it?
Right. So the same table which we were discussing in previous point, uh, there are options. I think there is an option which talks about ITC available but not availed, and then there is an option which says that ITC available but lapsed. That means you are not able to claim it on time, right? So that was the most disturbing factor so far as this annual return format is concerned, because initial view was looking at the formats without looking on the portal. It was only a PDF format initially, right, which was released by way of a notification. And my first review to it, and I was like, what if my ITC does not match, or maybe I'm not able to claim it? Does that mean that I'll be required to pay the entire thing
Yes.
to the government while filing the annual return, right? And the biggest worry was everything is driven by technology, right? If I do not pay, or maybe I take a chance and I choose to litigate it, I do not pay, or maybe I have a good vendor follow-up mechanism which can help me to realize that missed input tax credit, right? If I plan to do those sort of things, will my portal allow me to file my annual return before even uh, paying those liabilities in case,
Liabilities.
right? But again, this is something which government has been doing good, that they obviously throw the problems but they come up with a clarification. And on this point as well, they clarified that the information we are seeking, if there is a positive or negative difference in that particular table, you do not need to worry about it. It's only this information government is seeking only for informational purposes. There is no action, or I would say there is no immediate action which you need to take or which would be taken upon you because of those reportings. If there is a positive uh, difference, which means your two-way numbers are more than the ITC which you have availed, then it's fine, right? Because you have availed less. In that situation, you would want to see that what have I missed for a particular financial year, and if there is still time, you would want to avail that ITC. Right, but if it is the inverted situation where your two-way ITC is less and you have availed more in your annual return or maybe in your monthly 3B returns, now that is one situation where you would want to avoid the future notices, right? And that's where you would go for invoice level, like we discussed for table 8A, there is an invoice level transaction summary which is available. You would download it, you download the report, reconcile it, close the gaps, maybe follow up your vendors, close the gaps, prepare a reconciliation statement. There is also an instruction which talks about reconciling the negative difference and then uploading it along with form GSTR 9C. I've practically not seen anyone doing this for a long time. But yes, that is again one option. If you are hands on with your reconciliation, that is something which can be done. Otherwise, you have time until there is a two-way mismatch notice on your table.
Okay. Okay.
Right.
So, when you were saying about the clarification by the government, so recently I read about this clarification the government gave about the data of 2017-18 in 1819.
Yeah.
So, how are we treating it? Is that data required to be entered, or as per the clarification, they say it's not required? So, what is the scenario there right now?
This is something I think which was clarified in last 10-15 days only, because
Yes.
the format of return never gone through any change. Like what we were using in 17-18, there are only financial year references which have been changed by way of amendment notification. Other things remain the same, right? So obviously 17-18 was first year of GST compliance. There was nothing coming from 16-17 which was supposed to be reported in annual return for 17-18. But when I am doing compliances for financial year 18-19, there are adjustments, there are numbers which were pertaining to 17-18, but they were dealt in my returns in 18-19. And now then there was a doubt that fine, 17-18 adjustment I have done and return in 18-19, but how am I supposed to report it in annual return? Right? I would somewhere need to bifurcate and show that the numbers which I am reporting in 18-19 annual return, it does not pertain to this financial year. These are previous year adjustments which have been rolled over. Right. If I do not report it separately, or maybe I do not report it at all, then it would obviously give a difference between my audited financial statements and my annual return reporting, because audited financial statements obviously would not have a number for 17-18. I would compare it only with 18-19 financial
Current year,
statements.
correct. Hmm.
Right. And that's where the government clarified, I think 10-15 days back, that you do not need to report those adjustments again in financial year 18-19. And this, I think, is very helpful so that pan India, all taxpayers or consultants, all return preparers, everyone is able to follow a single stand, which would be helpful for department as well as for taxpayers. Right. So what government has in a sense clarified, it is that the reporting you are doing in annual return is based on the year to which such transaction pertains, right? So 17-18 adjustments made in 18-19 but reported in 17-18 annual return, you do not need to report it again in financial year 18-19 annual returns.
I think they have also clarified that if someone has already filed the returns with these details, it's not going to be considered null and void,
Yes,
if I'm
yes,
right.
yes,
They
yes,
have
yes.
clarified that as well.
Yeah,
Okay,
because I
great.
think 5 to 10% of taxpayers all over India have filed before this clarification. We,
Yes.
if I give you my stand, we were half prepared, but we were waiting for a clarification on this point. There were many cases. We were waiting for the clarification. Good that it has come now, and based on this, we are maintaining the stand.
So right now when we're talking about two terms, that's 17, 18, 18, 19, correct? When we're talking about these two terms, I think you mentioned that there is nothing changed from 17, 18 to 18, 19 in the forms.
Yes, yes.
So what do you expect for 1920? Is there anything that you expect will change? Because that is also going to be coming now soon after this is done.
Yeah. So, one particular point, as I mentioned, that 17-18 was the first year. Now 18-19 is second year. Ideally, it should have the column for adjusting anything which has been rolled over from previous year. It was not there, but fine, there was a clarification, right? But I would say if I compare annual return formats for financial year 17-18, 18-19, and 19-20, there was a trend of making things optional. If you look at the format 9 and 9C, there are many tables, but more than half of it have been made optional because I would agree those are complex, right? There is still time to implement those level of details in Indian tax compliance structure. Maybe that line is not far, maybe 3-4 years or 5 years down the line, but yes, I agree today is not the time. If I talk about four particular details which were very, very complex, like the HSN summary of inward and outward transaction, and then in GSTR 9C first table, there is a reason-based turnover reconciliation that if you have a opening unbilled, closing unbilled, credit note adjustment, commercial credit note, trade discount, all those have to be reported separately, right? And then there was a column in GSTR 9C which talks about expense wise ITC reconciliation, where you need to map each and every expense to your P&L subhead, right? And then there was a separate bifurcated reporting of ITC which you have availed on input services and capital goods, right? These were the four things which were very complex so far as reporting requirements were concerned. The primary reason was that these information points were never part of monthly compliances. So more than 99% of the taxpayers, I would say, have never maintained these information. And then in annual filings, if you come and seek these information, it's very difficult for a taxpayer to provide that, right? And that is one reason. I think the optional things which were there in 17-18 were carried forward to 18-19. All these 4 points were optional in 18-19 as well. 5 days back, I think on 15th October, there was a notification for changes pertaining to annual filings for financial year 1920 as well, right? So we have decoded the notification, and primarily we do not see any much change in 1920 format as well. Whatever things were made optional for these 2 years have been carried forward to next year as well, including the exemption, threshold exemption, like people from 2 to 5 crores of turnover are optional. They have option to file 9C or not to file 9C, right? They have an option, right? But there is one point which I would want to highlight and everyone to note, that when you look through that notification, like we were discussing, there was a bifurcation earlier which was required between input services and capital goods, right? You would note on decoding that notification that for financial year 1920, there is a requirement to separately report the input tax credit which you have availed on capital goods, right? So that is one point you can take note of. Other than that, whatever was optional in 1819 continues to be optional for 1920 as well. So you can take a rest, take a break for that part at least. But yes, capital goods point, maybe it is relevant for government's information for refund purposes, because you guys would know under LUT route, the refund of capital goods is not allowed. And maybe that is the reason government is seeking this information separately. Or maybe there is a reason that there can be substantial capital expansion, because of which there can be huge amounts in capital goods which are taken as credits, right? And that can be reason where the government is specifically requesting this information separately.
Okay.
But yes, this is something which is required.
Okay, great. So when we're talking about 9C, that is about the consolidated disclosure in table 5N, 50, if I'm right,
Yes, yes,
regarding the
yes.
reconciliation adjustments.
Yes.
So there are people who have questions that should we individually mention everything from 5B to 5N and then finally have a consolidated version of it in 50. So what is your take on it?
My take would be the same which I have given for notice, because for me, notice is not something to be afraid of. Notice is simply a letter where someone is trying to seek information from you, right? Now, though government has clarified, right, there are multiple columns which I just mentioned, like trade discount, opening unbilled revenue, and then closing unbilled revenue, and unadjusted advances. Many such things are listed over there. But since taxpayers were facing problems, government has given an option. Fine, you state the reasons, whatever your reconciliation items are, but consolidated gap you can report. I think 50 in 50 you can report it on a consolidated basis, right? As soon as this option was given, I've seen 100% taxpayers going for the option of reporting a consolidated numbers,
Consolidated.
which I agree, it's fine. But if you want to have my view, my strict view on it, my view would be, see, if you are confident on your numbers, if you have the details, then there is no problem in reporting it, right? Tomorrow a notice would come and you are anyways required to report it. Yeah, so your reporting talks a lot about your confidence, your hold on your numbers,
Why
right?
not now than later?
Right. So yes, there is an option if there is smallest. doubt which is there, yes, you should go for consolidated reporting. Otherwise, I think if you can split the items into what amount of reconciliation gaps pertains to unbilled revenue, what pertains to commercial credit notes, what pertains to adjustments, and whatever items are there, right? Those, if you can, you should report separately. Otherwise, you have an option.
Okay, great. Now coming to my last question before we keep the forum open for questions. So
Yeah.
that's the topic of our session, how we have termed it, the checklist for uh, GSTR 9 and 9C filing. So any 5 points you can suggest that please do not miss checking these before filing this.
Uh, yeah, sure. So I keep on reviewing many annual returns. So there is my personal checklist, which I keep on checking from taxpayers' perspective, from consultants' perspective, as well as from departments' perspective or revenue authorities' perspective, right? Uh, so I'll give you 5 points definitely. One would be, I think, there is a 20% logic which is incorporated in the portal. I think most of you would be aware about it, but initially I was not aware about it. So what happens is, whatever monthly GSTR 3B filings you have done, that number is auto populated on your portal in GSTR 9 at all the places, whether inward, outward, whatever numbers are there reported in your monthly returns, those are auto populated. And then you have an option, like we discussed, if something is missed out, you have an option to correct it, rectify it in your annual return, right? You can remove that number, you can insert your new number. But there is a logic which is running at the back end,
Okay.
which basically computes the variation in auto populated number vis-a-vis what you have reported. If that variance is more than 20% plus or minus, after filing your return, that number is automatically converted to a red text, right? So whenever department will download your annual return from their login or maybe from your login, there will be separate entries which are highlighted in red, which would mean that your monthly number as well as your annual number had a variance of more than 20% from base amount. Right. So at draft stage, if there is some number where you feel that there is more than 20% variance, I would say this would be the first checkpoint. You go back, re-verify, check what has led, what event or maybe what transaction has led to this huge difference, and then you can decide that what is the appropriate action which is to be taken on it.
Okay. Okay.
Right.
So that's one. Yeah.
Second, yeah, that's one. Second point would be on annual return table 9. Now that table is really very complex. Right. So table 9 is typically the comparison of your tax payable and tax paid. Right. So it is a very easy comparison, provided you had an option to report both the numbers. But this is not the case, right? There is a number which you have to report, and there is a number which is auto populated. The tax paid number based on your monthly consolidated filings is auto populated. Now this number is static, you cannot change it,
Change it.
right? And this is something which you have to reconcile, right?
Mm.
So now the problem is, when we go to table 9, my CGST, SGST, IGST, interest, late fees, penalty, others, everything is auto populated over there, which is fixed, which cannot be changed, right? And then you have reported all your adjustments in first, second, third page of your annual return. And when you come down to table 9, it's the consolidated tax liability which you were supposed to pay, right? If you compare these two numbers, I've hardly seen it reconciling for big entities. For small entities, maybe 50 CR, 100 CR, they reconcile. But whenever there is a complication, there is obviously some adjustments or maybe industry specific accounting principle, revenue recognition principles, credit note. There are many reasons that those two numbers would not reconcile, right? If those numbers are not reconciled, then there is a problem, because then there is a liability which you are declaring which is payable, right? And there is a tax which is auto populated. There can only be two scenarios. One is that your payable is less than your tax paid, right? In that case, again, we would need to go for DRC 03 voluntary tax payment route, which we have discussed, and we would need to discharge the additional liability through DRC 03. But in case it is an inverted situation where your tax paid is more but payable is less, right? Now that is one point where taxpayers again need to take some further action, because that typically, in my view, would be a situation where someone would have paid an excess tax, a tax which was not payable but paid to government, maybe by mistake, by clerical error, or maybe by way of not reporting the credit note, whatever is the reason, right? Now, interestingly, GST return, GST provisions has provision for refund of tax which has been paid in excess, but that cannot be availed through annual return. That has to be filed separately, right?
Okay.
So in case that is the situation, the bottom line of my checkpoint would be either you pay your additional tax to set off or reconcile those two numbers. If there is an excess, you identify the reason, check your time limit. If you are within 2 years of the event which has led to that excess tax payment, you go and pay those taxes. Oh, file a refund claim under the
Refund
excess
payment
tax
for it.
category. Yeah.
Mhm. Okay.
Yeah.
Okay.
Third point would again be related to table 9 only. There is a small row over there which talks about the late fees, right? Late fees typically means that you have filed your GSTR 3B belatedly, right? Now, this is something which is auto computed by the portal. If there is some amount which is auto populated in table 9, that means within the financial year, you would have paid something, maybe some amount related to late fees. If you have paid late fees, then obviously there are some returns at your end which have been filed belatedly, right? Now, while portal auto populates or maybe automatically computes the late fees amount, it does not automatically compute the interest, right?
Okay.
So this is one point, that if there is a number in your late fees, then obviously there has to be a number in your interest as well, right?
Correct. Mhm.
Yeah, so this is one thing which department would want to check. They are smart enough and they'll obviously come back looking for something related to this point as well,
Correct.
right?
Yes.
Fourth checkpoint would obviously be on the table 8A, which is the most complicated table, the auto-populated two-way numbers, which we have discussed at length, right?
Hmm.
Positive, negative, ITC lapse, or maybe additional ITC available. We have discussed those action points. Whatever is required to be done has to be done over there, right? And
Yes.
fifth one, and most importantly, I would say that whenever there is a taxpayer who is into providing taxable supplies as well as exempt supplies, right? So there is a implication of input tax credit reversal. So whatever common credits you have availed, you are liable to reverse the proportion of which in proportion it relates to your exempt supplies, only for the reason that you are not paying outward taxes on those supplies, right? Now there are rules, rule 42 and 43 under GST, which prescribes the criteria and the manner in which those reversals have to be done, right? Why I'm saying this, in service tax also there was a similar provision. There was a rule 63. In GST it's rule 42 and 43, which requires all taxpayers to do a monthly reversal,
Okay.
which everybody does normally. But then there is also a requirement to recompute your numbers on annual basis and do a annualized true up in those numbers and recheck the proportion what is required to be reversed in terms of common ITC based on proportion that you have, right?
Okay.
So that is one point. Again, I would ask taxpayers to check that, yes, if you have exempt supplies as well. I know that most of you would be doing the 42, 43 reversal, but yes, there is also a requirement to analyzing those numbers and recheck based on your proportion and the manner of declaration in which you declare that in annual return. Ideally, what has to be done, the monthly reversals which you have done can be reported in the annual return, right? But there are separate tables like table 10, 11, 12, 13, I think, where the annualized number is has to be separately reported. Like any adjustment to ITC, any additional reversal has to be separately reported, right? So as a part of your annualized reversal exercise, if you feel that if you come out with a number that there is something additional reversal is required, do not reverse it on top of annual return. You have to go down to table 11, 12, maybe I'm not sure which is the exact table, but there are two tables, 11, 12, which exactly talk about the uh, ITC reversal or adjustments on ITC, right? And I think those would be the five checkpoints from my side.
Great. That's been really informative. Great. Yes, as we are running short of time, if the audience has any questions, please type it in the chat box so we can quickly pick it up and answer. So, as and when you all are typing the questions, I'll read it out so that can answer. But then, yes, so far we have had wonderful knowledge which has been shared. And I'm sure everyone has gained with it. And I can already see someone writing for us that the session has been really informative.
Thank you. Thank you, Ashish.
Yes. So, are there any questions? The point is, he has elaborated everything so well that most of the doubts are just cleared. I think, okay, we'll just wait for another minute as we have a hard stop at 6:45. So if anyone has this, just say hi and then you can continue typing. So we know that you're typing. Okay. So I do not see anyone actually proceeding with questions. But anyways, if any of you have any questions, yeah, we do have one here. Need to check if we need to bifurcate India's adjustment state-wise or to show it from head office.
Uh, so these adjustments, right? Whenever there is a turnover, like we were discussing, like GST is a state-based concept, and whatever numbers pertains to a state, that has to be reported in a particular state GST annual return or maybe audit report. But that is something which would strictly apply to uh, the transactions which are either taxable under GST or maybe exempt under GST, right? I think the Ind AS adjustment which you are talking about, there can be a scenario where this is taxable, but all in all probability, if this is just an adjustment, it would not relate to any particular supply, right? And if you are reporting it as adjustment in your books of accounts or for your head office location, that is something which should be fine, because in my view, if this is something which is not taxable, not exempt, not even liable to GST, does not concern GST authorities in any way, then there is no point of bifurcating it on a state level basis, right?
Okay, great. Is there anything to add more, Siddharth, to Ashish's question?
No, I think he has already commented that. Got it. Thanks.
Okay, great. Mr. Subodh, yes, the session will be available on our social media pages. Plus, you will get an email after the session to watch the recorded version of this video. Otherwise, you can find it on Masters India's social media pages. We have a question from Mr. Pankaj, which says if any company exports under LUT along with local sale or services.
I
Uh,
think the question is incomplete. Then it also reverses the input. No, so input tax credit reversal is not required pertaining to export, right? And in fact, if you see the definition of zero rated supplies, if you export goods which are exempt under GST or maybe not liable to GST at all, if you export alcohol, even then you are not liable to reverse your input tax credit, because export is something against which government does not intend to have any burden on taxpayers, right? So the input percentage reversal or proportionate percentage reversal things does not apply on export versus domestic sales. It typically applies on your taxable versus exempt sales. To answer your question, it would be there is no requirement to reverse the ITC in proportion to export.
Even for export
Even for
services.
services, even for services.
Great. Okay. Okay, I think we have answered Mr. Pankaj's question. We will take one more question if anyone has, and then we can close for the day. Great. Thank you, Mr. Pankaj. Okay, so I think we can close the session for the day. Thank you so much, Siddharth. It's been a wonderful session, great learning, and we had a great audience.
Thank you
I'm
so
sure
much.
you would
Thank you
agree with me
everyone
for
for
that.
joining. Yes, yes,
Yes.
thank you everyone for joining, and I'm glad that you all took out time in evening to join the session. I know that today is 20th and it's really hard for people to take out time on due date of filing GSTR 3B, but it's actually very good for us as well.
Thank you so much, everyone. Just a quick thing before we sign off. If you all are interested in more sessions and if you all have suggestions that what kind of sessions, topics you all want us to cover, you all can write to us as an email or you can write to us on our social media channels. We will be glad to do it. But do stay tuned in for many more sessions and looking forward for a lot more sessions with you, Siddharth, as well.
Sure, sure, sure. I look forward to that as well.
Great. Thank you so much, everyone. Have a good day. Bye bye.